Welcome to The Deep Dive. We're the show that cuts through the noise to bring you the insights that, well, really matter from key financial discussions. Today, we're digging into the recent Q2 2025 earnings call for Bank OZK. Our mission here is pretty straightforward. Pull out the crucial bits of info so you can understand what's really going on.
Absolutely. We're aiming to distill what management said, both in their prepared remarks and in the Q&A. The idea is to give you a clear, concise picture of how the bank's doing and where it's headed. Think of it as a shortcut to getting informed, hopefully with some interesting facts along the way.
Okay, let's start with a snapshot of the results then. Because, wow, the growth really jumps out this quarter, especially on the loan side. Management basically said their original annual loan growth target for the whole year. They blew past that in just the first 6 months.
Yeah, the momentum is clearly strong. I mean, loan growth non-annualized for H1 was 10.1%, which, if you just doubled that, suggests something over 20% annualized potential. So they've bumped up their official annual guidance now to a range of 11 to 13%.
Okay, that's significant.
And another point, we saw a little bit of positive movement on deposit costs. The interest-bearing ones dipped slightly in June to 3.68%, down just a touch from the 3.7% for the full quarter.
And credit quality. That seems to be a consistent story with them.
It really is. The net charge-off ratio, basically the loans they had to write off, stayed way below the industry average. That's been their pattern for a long time now.
What does that consistency really tell us, though? Is it just good luck or something more?
Oh, it's definitely more than luck. It points to, I think, a really disciplined approach to underwriting, deciding who to lend to, and how they manage risk. To beat the industry average on charge-offs so consistently, I mean, since '97 they highlighted, suggests a credit-first culture. It's baked into how they operate.
All right, let's move beyond the snapshot then, and really start our deep dive. The Corporate and Institutional Banking Group, CIB, seems like the big story here. It was the biggest growth driver so far this year, and management was explicit. They expect CIB to accelerate, not slow down, through the rest of this year and into 2026. This feels like more than just growth, right? Like a strategic shift.
Oh, absolutely. It's a very deliberate strategic pivot. By pushing CIB growth, Bank OZK is actively trying to rebalance its loan portfolio. Historically, they've been very heavy in real estate. This move diversifies them, makes them less tied to one sector's cycles, and potentially adds higher margin business.
Right.
They're essentially reshaping their business model for more resilience down the road. CIB is about bigger relationship-based loans across different industries.
And while CIB speeds up, their traditional powerhouse, the Real Estate Specialties Group, or RESG, is facing some headwinds. Higher prepayments.
That's right. They give some pretty specific numbers, too. In the first couple of weeks of this quarter, Q3, RESG saw about $0.47 billion in prepayments. And more recently, that number climbed to $0.54 billion. And it wasn't just one type of property either. It was New York multifamily, Dallas multi, Miami land, Washington state multi, Chicago mixed use, Chicago multi. Pretty broad-based.
Okay, so RESG loans are getting paid back faster. But does that mean they're shrinking that business?
Interestingly, no. That's the fascinating part. Even with those prepayments hitting, RESG's funded balances actually reached an all-time high this quarter. But, and this is key, its share of the total loan portfolio has dropped. It used to be around 70%. Now it's down near 60% over the last couple of years.
So it's still growing, but other things are growing faster.
Exactly. It's proof their growth and diversification plan is actually working. They're intentionally lowering that real estate concentration risk, making the whole bank safer, while still being a major player in RESG.
So the message is, we're not backing away from real estate. We just want CIB, indirect lending, commercial banking, to grow even faster. It's about relative growth.
Precisely. And it's not just CIB. Indirect lending is still growing, staying within that 10-15% target range of the overall loan book. Plus, their community and commercial banking teams are stepping up consumer lending through branches and launching these new business banking teams in Florida, Texas, Georgia. Key growth areas.
Okay.
The idea is all these pieces will contribute more to both loans and deposits over time, spreading the bets,
Makes sense. But that kind of growth across the board, especially in new areas like CIB, needs fuel. How are they staffing up? Where's the talent coming from to support this?
Crucial point. They added 109 new full-time people just this quarter, spread across the bank. A good chunk of those hires are going straight into CIB as planned, and also supporting those new business banking teams in Florida, Texas, and Georgia.
And these aren't just entry-level hires, presumably.
No, definitely not all of them. Especially for CIB, They're bringing in experienced people, often from bigger banks. These folks bring relationships, specialized skills for complex deals, maybe a different kind of market access. It's like a fast track to building out that CIB capability.
Management seemed to suggest they weren't just relying on M&A fallout either, that their own culture and reputation were big draws for talent.
Yeah, they emphasize that. They believe their track record and culture attract top performers directly, which is a strong position to be in, especially when good financial talent is always in demand. It's a competitive edge.
Okay, let's switch cues to the funding side deposits. What's the story there? They mentioned time deposits and using the branch network.
Right. On the cost side, they expect things to be pretty stable for interest-bearing deposits until the Fed decides to move rates one way or the other. But what's really interesting and maybe a bit under the radar is how CIB is already helping on the deposit front.
Oh, really? How so?
CIB deposits grew almost 20% just quarter over quarter. Now, the huge loan growth kind of masked the overall impact this quarter, but that kind of deposit growth within CIB tells you these new relationships are becoming core banking relationships, bringing in funding alongside the loans. That's exactly what you want to see.
That is interesting, and it leads right into the fee income question. If CIB is bringing in deposits, is it also starting to generate those non-interest fees?
It is, but they stress it's still early days. They are seeing progress in areas like treasury management services, helping clients with interest rate hedging, capital market stuff, and loan syndications where they lead a deal and bring in other banks.
So potential there, but not fully realized yet.
Exactly. Management's looking more towards 2027, 2028 for CIB to be fully firing on all cylinders with fee income. It takes time to build out those services and relationships fully, but it's a clear long-term goal.
Of course, growth is great, diversification is smart, but you always have to watch the quality of the loans, especially when entering new areas. How are they managing risk? What did the appraisals show?
This is where they really seem to shine, that meticulous risk management. They've been incredibly proactive with appraisals. Get this. 98% of loans by count and 99% by dollar amount have been reappraised since December 15th, 2022. So basically, almost the entire book has been valued in the current higher rate environment.
That's comprehensive.
Yeah.
And what did those reappraisals find? With rates up, you'd expect values maybe to dip and LTVs to rise.
You would, but the impact was surprisingly limited. The overall weighted average loan to value, the LTV, only ticked up by 2%, went from 43% to 45%.
Only 2%? How?
Two main reasons. Paydowns on existing loans, bringing balances down, and importantly, the new loans they're originating have lower LTVs to begin with, so that conservative new lending is keeping the average down.
That makes sense. They did give a few examples, though, where LTVs did jump significantly, right? Like that office building.
Yes, they were transparent about that. There was a small office building that went over 100% LTV, I think 129%. A multifamily converting to condos, and a land loan also saw increases. But in each case, the story was the same. The sponsors, the borrowers, stayed involved. They put in more cash, added reserves, or paid down the loan balance.
So even when things got stressed, the guarantors stepped up.
Exactly. It underscores their focus on lending to strong sponsors who have skin in the game and will support their projects. That's core to their model.
What about those special mention loans? They ticked up slightly. Cause for concern.
Management described it as just normal ebb and flow. These are loans showing potential weakness, maybe needing closer monitoring or negotiation, but they're not actually defaulting. They said it was mainly driven by ongoing talks with sponsors, similar to what they saw late last year. Not a sign of a systemic problem, more like active portfolio management in action.
Okay, so zooming out a bit, thinking about the broader economy, how is their overall caution reflected in their reserves? How are they preparing for potential bumps in the road?
This is where their conservatism really shows. They are heavily weighting downside economic scenarios in their allowance for credit losses calculation, the ACL. Think Moody's S4, which is a recession scenario, and S6, stagflation. Those are getting more weight than the baseline everything is okay scenario.
And what's the result of that heavy weighting?
The result is a massive build in that allowance. Over the last 12 quarters, they've added $366 million to their ACL. To put it another way, for every $1 they've actually lost on loans during that period, they've put aside about $4 in reserves.
$4 saved for every $1 lost. Wow.
Yeah, it's like they're building an ark for a flood that might never come. It shows extreme preparation for potential adversity.
They feel pretty well cushioned then.
They definitely do. They did add the caveat that, if the economy looks much better and losses don't show up, those reserve levels could eventually come down. But for now, they are prioritizing safety. And again, this ties back to that incredibly low historical charge-off rate, maybe a third or fourth of the industry average since '97. They just don't lose money like other banks seem to. Sponsor support remains crucial there, too.
Okay, one last thing on the portfolio deep dive. Any specific color on different types of real estate? Life sciences, office.
Yeah, a bit. For life sciences, leasing is maybe slower than they'd like, but there's positive momentum. RFPs are active. Sponsors are still putting in equity to support the projects. Office, which everyone worries about, actually had some encouraging signs. They mentioned both large and smaller leases getting signed, so not dead, pockets of activity.
That's surprising for office.
A little, yeah. And then industrial and multifamily just continue to show strength. You see that especially in the repayment activity, which was strong across different segments. Good cash flows, good demand still.
Okay, so pulling this all together, what's the big picture takeaway for someone listening, maybe an investor or just someone trying to understand the banking landscape?
I think the picture is one of very deliberate execution. This isn't a bank just riding economic waves. They have a clear strategy for growth and diversification, and they seem to be sticking to it rigorously.
The focus on talent, that disciplined credit first, yield second, growth third mantra for CIB, that seems key.
Absolutely. And that 12% pull-through rate in CIB, looking at over $7 billion in potential deals, and only funding 12% of that tells you they are being very selective. They're actively avoiding deals they see as too risky, like highly leveraged stuff, or industries they think have headwinds, consumer discretionary retail, venture capital, tech got mentioned. It's careful growth.
So it's about building this diversified bank, but with risk management really embedded everywhere, even in the new fast-growing parts like CIB.
Precisely. They talked about building out the internal team's portfolio management, operations within CIB to make sure they can handle the growth without compromising quality or speed.
It does raise that question, though, doesn't it?
Yeah.
Can they keep outperforming the industry on charge-offs as they move into these new areas like CIB?
That's the million-dollar question, isn't it? Their track record is amazing, the reserves are huge, but diversifying does introduce new variables. It'll be fascinating to watch if that historical outperformance holds as the loan book changes composition. It's a high bar they've set themselves.
Okay, let's shift gears now to our segment. This is not financial advice. Remember, these are just thought experiments, maybe a bit out there, but plausible ideas to chew on.
All right, so given everything we've just discussed, you've got the accelerating high-quality CIB growth, you've got that super disciplined credit approach across the board, massive reserves, and still strong sponsor support in RESG. Here's a thought. What about considering, purely hypothetically, a long position in Bank OZK? Paired against that, maybe a short position in a basket of smaller regional banks.
Okay, what kind of smaller banks?
Ones that maybe don't have OZK's track record. Banks with maybe higher historical LTVs, perhaps less diversified income, maybe not as strongly capitalized or reserved.
And the thesis.
The thesis is pretty straightforward. Bank OZK's proven skill at picking good credits, their smart move into CIB, and those fortress-like reserves give them a real edge, especially if the economy stays uncertain. The idea is their ironclad balance sheet approach lets them gain market share and outperform while weaker banks might struggle. It's basically a bet on quality, discipline, and foresight winning out in a tougher environment.
Interesting pairing. Definitely plausible, it may be a bit bold. Remember, everyone, just a thought experiment.
Okay, great.
So that wraps up our deep dive on Bank OZK's Q2 2025 earnings. We've hit the impressive loan growth, the big strategic push into CIG for diversification,
The talent acquisition, the deposit strategy, that meticulous risk management with the appraisals, and the huge reserve build.
and even touched on specific asset classes.
Yeah, the main themes are pretty clear. It's a bank that seems to know exactly what it's doing, executing a plan, focusing relentlessly on credit quality, building reserves, and still managing to grow profitably. It's quite a case study.
We really hope this deep dive gave you some useful insights and saved you some time getting up to speed. As always, this is just for educational purposes, definitely not financial advice. Do your own thinking. But what stands out to you from all this? What questions pop into your head? We genuinely love to hear your perspective. Until next time, stay curious and keep digging.